Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Wednesday, February 18, 2026. Stocks finished higher, but it didn't trade like a celebration. The market tried to lean into Fed relief early, then the tone quietly shifted. Yields kept creeping up, momentum hesitated, and risk started to feel fragile. So yeah, the headline is green, but the real tell is underneath: narrower leadership, thinner breath, and a tape that felt more like a warning than a win. Now, look at the S&P 500 heat map. Mixed to green, but not a clean, uniform rally. You've got solid support in technology and communication services, big enough to keep the index looking healthy. Energy, clearly strong. But the defensive footprint stands out for the wrong reason. Consumer staples and utilities printed concentrated red, and parts of healthcare dragged too. That's the participation story. Selective leadership, uneven follow-through. Put that heat map into plain English. Money flow stayed concentrated. Capital leaned into growth and cyclicals. Technology and communication services held up. Financials looked constructive, and energy added its own pocket of strength. At the same time, defensives didn't trade like shelter. Staples and utilities were getting sold, which lines up with a market that's rotating and repricing more than its confidently expanding participation. And yes, small caps were green too, but they weren't the center of gravity. Here's the tension that defined the session. Indexes stayed green, but they faded off the early strength as yields climbed on stronger economic data. That matters, because this market is still very multiple sensitive. Inside the growth trade, the message wasn't everything AI, it was the highest conviction winners. Some names held, some didn't. That's how conviction drains, without a dramatic sell-off. So today wasn't explosive, it was diagnostic. On the chatter side, the theme was positioning. Traders talked about a flow-driven push in the morning, then an unwind later as volatility bounced and dealers likely shifted exposure. Important? That's market talk, not hard causality. But it matched the feel of the day, moves that were fast, mechanical, and more about comfort getting challenged than outright panic. Today wasn't just a Fed story, it was a positioning story. The morning rally in QQQ was largely flow-driven. The VIX dropped sharply, dealers flattened short volatility exposure, and that created a mechanical squeeze higher. It looked strong, but it wasn't fundamentally anchored. By early afternoon, momentum faded as traders waited for the 2 p.m. Fed minutes. When the minutes hit, the tone leaned cautious. Officials acknowledged progress on inflation, but made it clear the path back to 2% could be slower and uneven, and they did not signal any urgency on rate cuts. That subtle shift mattered. Rate cut expectations got scaled back, yields edged higher, and because the morning rally was built on positioning rather than conviction, the unwind was fast. Dealers likely flipped their gamma exposure, volatility bounced, and QQQ repriced lower into the close. So today reinforced something important. In this market, policy tone sets direction, but positioning decides the speed. Nvidia was still the headline proxy for AI risk appetite. Nvidia finished higher after Meta announced a deal to use millions of Nvidia chips in AI data centers. And that matters because in this market regime, Nvidia strength can make the whole tape look healthier than the median stock. But it also reinforces the day's theme: leadership is powerful and very concentrated. Meta mattered today less for the percent move and more for the signal. Meta traded higher on the Nvidia chip deal tied to AI data centers. That kind of headline feeds the AI capex story: who's spending and how durable this build-out looks. On a day when conviction felt thinner, those big capex breadcrumbs kept the AI infrastructure narrative alive. Exxon was a real rotation anchor. XOM was up around 3%, clearly outperforming peers and snapping a short losing streak. When a mega-cap integrated oil name moves like that, it changes the sector's footprint on the day, and it helped the session look more cyclical, not just AI-led. Energy leadership was one of the cleanest tells on the board. Goldman Sachs was another key piece of the tone puzzle. GS was higher in a session that leaned pro-cyclical. When financials participate alongside tech, it usually says markets are leaning into activity, capital markets, deal flow, risk tolerance, rather than hiding. It didn't make the day euphoric, but it kept the tape from feeling like a one-trade market. AMD was the contrast trade. Even with the Nasdaq up, AMD finished lower. That Nvidia up, AMD down split is one of the clearest selectivity tells in the AI complex. It's not automatically bearish, but it does underline today's posture: pay up for the top shelf leader, and stay picky everywhere else. Silver was the cross-asset headline. SLV ripped higher. A move like that matters because it can flag a parallel macro trade running alongside equities, rates, real rate sensitivity, and commodity momentum. With equities acting rate sensitive, it's worth watching whether that metal's strength sticks or cools off. For the next session, the question isn't whether something broke today, it's what happens with yields. If yields keep firming, the AI-heavy leadership trade gets tested again, and narrow leadership becomes a bigger risk. If yields stall, risk appetite can rebuild quickly. On the screen, keep it simple: Nvidia and Meta for AI leadership tone, XOM for cyclical breadth optics, AMD for semi-participation, GS for the pro-cyclical regime check, and SLV for the macro cross-current. On the calendar, FOMC member Waller speaks Monday and Tuesday, consumer confidence hits Tuesday, unemployment claims Thursday, and PPI on Friday. Wrap it this way: today wasn't dramatic. It was diagnostic indexes held up, but the under-the-hood tells participation, leadership concentration, and rate sensitivity did the real talking. Tomorrow, don't just watch the open. Watch whether leadership broadens and whether yields keep leaning against risk. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.